Welcome to the podcast from Morningstar UK, the leading provider of independent investment research. This week, we're going to take a look at the impact the US election has had on the global economy. Donald Trump has beaten Hillary Clinton to become the 45th US president. Stock markets globally have reacted by falling. Senior editor for Morningstar.co.uk Emma Wall and Chief Investment Officer Dan Kemp discuss what should investors do.
Hi Dan.
Good morning, Emma.
So it looks today as if Trump will be the next president of the United States. How have markets across the globe reacted to this news?
Well, the first thing to say, of course, it's still very early days, and so we are living through these initial reactions. But I think it's fair to say that the initial reaction was not good. It was most pronounced in Asia, because, of course, those were the markets that were open at the time, and we saw some very steep falls in asset prices there. And that's sort of started to creep through into Europe, but it's now a much more nuanced, mixed reaction. We can expect to see that with the news flow of the next days, weeks and months. But of course the important thing from an investment perspective is to look through that and focus on the long term.
So what can investors outside of the US do with this news then?
Well, the first thing is to avoid making the classic mistakes of investors, and that's either to be pulled along by the herd and as prices are falling decide to sell, or secondly to try and capture a bounce in markets. Both of these strategies are essentially gambling. We have no idea what markets are going to do in the short term. Certainly people didn't expect this sort of reaction when they went to bed last night and US equity markets had actually risen yesterday. So we can't anticipate what's going to happen over the next few days. What we can do is look at genuine value opportunities, some of which have become cheaper and will become cheaper over the next days, weeks and months, and use that opportunity to add to these long-term positions.
And it is a very important point to make that we are in early days, because although Trump has declared, Hillary has not conceded to that. And even if we are going to have a Trump president, we're not going to have a Trump president until January. So the markets have all that time, plus any policies he puts in after that, to react to all of this noise.
Exactly. And so investors are going to have plenty of opportunities to buy cheap assets. And even if you're looking at assets today and they look cheaper than they were yesterday, then just remember they can get much cheaper. Markets can be pushed to extremes, and so you might want to add to positions you like today, but leave some powder dry to keep adding in the future as news drives markets into unforeseen places.
And it also is worth remembering that if you don't have high conviction over any asset class at the moment, because let's be honest, we're in a slow growth, low growth world, it's okay to just do nothing, isn't it?
Absolutely. That should always be the default position. You should like the positions you had today as much as you liked them yesterday. And so there's no need to react. That's always the first temptation for investors, that they think it's better to do something rather than nothing. Very often it's better to do nothing and just keep doing the research, keep looking at great sources of news and data and work out where genuine opportunities are occurring.
Dan, thank you very much.
You're welcome.
What can investors expect from the stock market from the results of the US election? And what have we learned from the Brexit vote shock to help protect our assets? Simon Molica from Morningstar Investment Management is up next to discuss.
Hi Emma.
Hi Simon. So we are awaiting the results from the US election currently. What can investors expect from stock markets as the results roll in?
We've certainly got an exciting night ahead of us. It's been a very well publicised political campaign from both parties. I think what we've recently seen is the markets have begun to become a bit more volatile. So the VIX, which is a measure of volatility, has risen a little bit in the past days. Funnily enough, it calmed down a bit as we had news from the FBI that they weren't going to prosecute Clinton. But I think we can certainly see that if it's an unfavourable result, that potentially volatility will definitely pick up again. Currencies are an important one as well. If it's favourable and the view of the investor is that the Fed could move in December because of the outcome potentially, then that could support the dollar. If it was a different outcome and Trump was to come in, then obviously there's dollar peso volatility that could happen as well, as there's implications potentially between the US, Mexico for trade, etc. So it does mean for a lot for different types of asset prices, absolutely.
Here in the UK, we have experienced the result of a shock political result in the last 12 months. In the day following the Brexit result, $2 trillion was wiped off markets globally. Should we find ourselves in that situation again tomorrow, what should investors do?
Yes, it wasn't very long ago, but it does feel like a lifetime ago. Yeah, it's amazing. Really, what we saw was a knee-jerk reaction, a massive sell-off, then to a rebound as well. And I think this really plays to the point, and particularly what Morningstar tries to sing home about is let's not overreact with things. We build well-balanced portfolios with different underlying drivers to our portfolios as well. So I think people should be very careful about reacting. What they need to do is think about fundamental research and not just overreact to a point. And if I may give a quote from Warren Buffett, investing is simple, but it's not easy. And the crux of that really is that the basic logic of investing shouldn't be hard. It's not a hard concept. However, the emotions and the psychology of investors actually gets in the way. And sometimes, we go against ourselves and we actually make it harder. And I think the idea of overreacting to a shock news is something that can be bad for investors. There's studies in the US that we've done as a company which shows that if you were to miss the 10 upswing days of the last 10 years, you can actually halve your return. So it's very concerning if people were to be out in the market for some time and just based on one result, really.
And to that end, with the Brexit result, we have seen the FTSE 100 rally significantly since then. So if you just held tight, closed your eyes, switched off the TV, you would have been fine. And I suppose the other thing, as well as holding your nerve to protect your portfolio, would be diversification.
Yeah, we're a big believer of well-balanced, diversified portfolios. And absolutely, the best situation from Brexit was to hold your nerve. Not necessarily to ignore it, because we do believe in fundamental research. It's important to research into these things, but really to move when you've got a reason to move and not just as a reaction to a binary outcome.
Simon, thank you very much.
Thanks, Emma.
How are professional investors reacting to the economic and political challenges of 2016? Especially after Brexit and the US election have thrown up significant volatility. Fund analyst Randal Goldsmith is up next to give us his insight on why it's been a challenging environment for fund managers to make investment calls.
From our recent discussions with multi-asset managers, we've found less common ground than usual and generally lower conviction. About the only commonality we've really found is that managers have found this year a particularly difficult one in which to make investment calls. Why is that? There have been a number of challenges this year. The first has been market volatility. The year began with equity markets in sharp descent, then followed by an equally strong recovery from the middle of February. Another challenge has been stock and sector rotation. Previously, stable growth stocks had outperformed value in cyclicals for one of the longest periods in history. The outperformance by small and mid-cap stocks had been equally extended. The final challenge has been the Brexit and presidential election votes. In each case, opinion polls have shown the votes to be close, but on the other hand, the implications for which stocks will outperform have been significant. For example, following the Brexit vote, investing in international stocks, that's been a clear winning strategy. So how have fund managers responded to this? Generally by reducing directional and style bets in their portfolios and instead emphasizing fund and stock specifics.
What will President Trump mean for bond yields? Will the Fed raise US interest rates next month? And what will that mean for global bond markets? Charles McKenzie, Chief Investment Officer for Fixed Income for Fidelity, discusses all this and more with Emma Wall up next.
Hello, Charles.
Hello.
So a week after the shock election of Donald Trump as the next President of the United States, prior to this result, we were very much expecting the Fed to raise rates in its meeting in December. Do you think this will still go ahead?
Well, no, I do. I think it will certainly go ahead in December. In fact, the markets are almost giving it 100% probability that the Fed is going to raise interest rates in December. So I don't think that's changed anything at all.
And looking to what we were expecting from 2016, the Fed indicated there would be 4 rate rises. We haven't got that. What should we expect in 2017, in particular because a lot of the policies that Trump has spoken about are inflationary?
Yes, and I think the markets are trying to work out exactly what the Trump victory means for the US Treasury market. Clearly at the moment there's an awful lot of concerns about reflating the US economy and how inflation might feed through into the US system. And of course a much greater perhaps fiscal spending, a greater supply of government bonds coming to the market, meaning there has basically been a bear steepening of the market, i.e. that longer dated US Treasury bonds have been underperforming. Now what does that mean? Well actually the Fed are probably likely to raise interest rates going into 2017. And we're expecting probably about 2 rate hikes going into next year.
Of course, we don't have to wait for a rate hike to see a change in bond prices. This is a market at the moment that is so much about sentiment in both the fixed income world and indeed equities. And we have seen bond prices reflect those rate rises to come, haven't we? Which is causing some people to say, this is it, finally, the bond bubble is bursting.
Yes, and you're right, and the markets have reacted very aggressively in terms of that. But we also have to step back a little bit, although we're right now in the middle of what feels like a storm. And US Treasury bond prices have sold off, but yields still are lower today than they were at the beginning of the year, which is, so I think we just need to take some sort of perspective on this. I think we also have to be aware there are still significant structural headwinds to global economic growth. We have a huge amount of debt in the global economic system, so it's going to be quite hard for global economic growth really to power through. And we are really talking about the US economy here. If we start expanding our horizons into Europe, into Japan, into emerging markets, the headwinds to growth are quite significant. So it's really only the Fed who are likely to be in play in terms of raising interest rates. Other central banks are still on the mantra of keeping rates low and very much looking for quantitative easing. So I certainly think it's very premature to call the end of a bond market rally, because there's an awful lot of structural headwinds in other parts of the world which will keep yields relatively low.
Of course, that means that if the US does raise rates and indeed other parts of the world keep this very low rate environment, we will see a disconnect where at the moment, over the last couple of years, developed markets have sort of been moving together. What does this mean for investors of bonds to suddenly have this two-way market?
An opportunity. Actually, I think it does give a great opportunity, because bond markets can only dislocate so far. There was always going to be a link between different bond prices. But what I think it certainly gives bond investors are opportunities. Greater volatility gives greater opportunities. So people can certainly look for opportunities in, for example, regional differences, but also in inflation-linked bonds compared to nominal bonds. Within the credit markets, there's clearly all sorts of changes in regulation which is going to affect perhaps the financial sector. That will undoubtedly throw up opportunities for bond investors in the months and years ahead.
Charles, thank you very much.
Thank you.
Concerns about President-elect Donald Trump have clearly crossed the pond. Just hours before the start of the US election, we took to the streets of London to gather people's views on the outcome and how a new President of the United States may affect life in the UK.
I do, yeah. And why? Because it's going to have a knock-on effect on the opinions of everyone around the world.
Oh, yes. The bad news is we didn't like either candidate.
Definitely I do care about US election, because this controls the whole world, isn't it?
I think it's a catastrophe. Like, both candidates have like their disadvantages for the population there.
It's important for the Western world.
No.
And why don't you care about it?
Because both people running for president are not suitable for the position.
It does sort of indirectly affect me in this country. It's an important issue.
As an African-American individual, it scares me deeply if Donald Trump becomes president of the United States.
They provide a great world leadership, and I want a peaceful world and a booming world economy for us all, hopefully.
It does worry me if Donald Trump gets elected, but then it worries me if Hillary does as well. So, but I'd rather a woman than a man.
If you're allowed to vote, who would you vote for? Hillary.
Vote for Hillary Clinton.
We'd vote for Hillary.
Yeah,
I mean,
Hillary.
we prefer Bernie, to be honest.
Definitely Hillary Clinton.
I wouldn't bother voting. None of them are worthy of a vote.
I'd abstain to vote.
Oh, Hillary. 100%.
I think it's a wonderful country, great, but I'd vote for Clinton.
I think I'd go for Trump.
I would vote for Clinton, as they say, the lesser of the two evils.
Why do you think people support Trump?
I have got no idea. No idea. I wouldn't.
The way that he talks about things is just great at preying on people's fears.
I think he's a good administrator, isn't it? And he's a businessman, and people think like he can bring the economy up.
There's definitely an increase in right-wing voting in these economic circumstances.
This whole movement to globalisation has left lots and lots of communities with very little to hope for.
People are disappointed in politics.
He has managed to excite and wake up parts of people's minds that they were afraid to unleash before, but now that they have this man on a platform that has voiced all of their incredibly racist and incredibly dark thoughts.
Some people say that Brexit is similar to the US election. What do you think about it?
It's nowhere near in comparison. No, nowhere near. Ours was a life-changing decision. Theirs is very minimal.
I do think there is some linkage into that the world is moving in two directions and lots of people aren't benefiting from it.
Well, they're appealing to the same sort of people, the uneducated, the ones who live in towns which have lost their major industry or their mine. I think that a lot of the same sort of people who voted for Brexit probably are going to vote for Trump because they feel disenfranchised and they feel they're not getting what they deserve in life, so probably they will vote for Trump.
Think 2016 has been the year of political upsets? Europe faces a referendum and general elections galore in the next 12 months, as well as extra low interest rates, explains Will James, manager of the Standard Life European Equity Income Fund.
Hi, Will.
Hi.
So we have faced quite a lot of political turmoil in the UK and the US in 2016. However, 2017 is going to be the year of European geopolitical concerns and uncertainties. How do you, as a European equity fund manager, manage money in that environment?
Well, firstly, I think we've had a pretty good experience at navigating political turmoil over the last sort of 5 or 6 years. I mean, we've seen everything from sovereign debt crisis, the Greek crisis. So we feel as if we've got a fairly thick skin when it comes to sort of political crises. The way we look at investment at Standard Life Investments is just really to make sure that we're comfortable with the type of investments, type of companies that we're wanting to invest in. That we're comfortable with the fundamentals, comfortable with the business models, comfortable with what is priced in versus the expectations that the market may have, albeit very, very cognizant of the macro and the political situation. So I think we're ready for it. I think the one thing that we know for certain is volatility will be here. And we've seen that this year, obviously in different regions, and we wouldn't expect that to change really next year. But I think the market has got used to a level of political risk. It has been reflected in share prices to a degree, and we've just got to be able to navigate that as effectively as we have done in the past.
As well as the sort of political uncertainty, we've got the Italian referendum, French and German general elections. Yes. Also, the backdrop for Europe is the central bank easing. We've obviously had quantitative easing in Europe for some time, and we've got Mario Draghi saying that whatever it takes statement that looks like it's going to continue to set the theme in 2017. Yeah. That, of course, has had an impact on asset prices. You, as an income investor, will know that low bond yields has pushed people into certain income stocks, which have pushed up prices. Yeah. I mean, how much higher can these go, or will we see a correction in that?
Well, I think we've actually seen a bit of a correction over the last sort of 6 to sort of 8 weeks, to be honest. We've been very, very cognizant of that risk. So at the end of 2014, where in fact we start to see a real flood into the sort of bond proxy type names that we'd traditionally been quite comfortable investing in. We took a very, very hard look at the valuations and a very, very hard look at who the marginal buyer of those equities were. And therefore, we've been fairly early, I think, to be able to identify the risk to that bond proxy argument. So as a result, we have been cognizant of the downdraft that could come as a result of the market's reassessment of rates, of growth, of returns. And I think, to be quite honest, we've started to see that a bit, especially post the Trump result last week. So, as ever, we really feel that you've got to be very, very valuation sensitive in these type of markets. So where we are today and looking forward, some of those bond proxy type names are actually post the last sort of 6 or so weeks have started to become a bit more attractive from a valuation perspective. And when we look at next year, and I think the debate is, the sort of, I suppose, we'll have to see what happens. But if the Fed starts to move, the question for the market, as it is questioning at the moment, is does the Bank of Japan, does the ECB start to use that as cover to start thinking about a different approach to the monetary easing that we've seen over the last period. So I think it's going to be a really interesting time into next year in terms of that market dynamic. And we think that actually an environment that is predicated at this point in time of low growth, low rates, low return is being challenged. And I think, fund managers and the portfolio has to be ready for that particular challenge, and I think we are.
Well, thank you very much.
Thank you very much.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.